Hello everyone and welcome to our third lecture in computational finance. We've now talked about portfolio theory, the general basics and the framework of Harry Markowitz's portfolio theory. We've talked a little bit about the main methods in numerical analysis on how to solve a system of linear equations. And next, we want to extend our understanding of portfolio theory into the direction of portfolio optimization. We want to see how you can actually use real data, how you can try to optimize your portfolio. And this leads us to the capital asset pricing model, the CAPM. It leads us to portfolio optimization in general, but also in the end to more sophisticated methods of optimization. This is where we'll be talking about convex optimization. So this is our topic. These are our topics for today. So let's start. We've talked about portfolio theory, how it is set up and how it was set up by Harry Markowitz. We want to concentrate on a mu sigma strategy, trying to maximize mu, the expected return on a portfolio, on a single investment, while at the same time regarding volatility, sigma, variance of volatility, as something undesirable. So that's the risk-return trade-off we have here, and we operationalize this by looking at the mean return and the volatility of the investment, or the variance or standard deviation of the return. So that's the volatility, and this will bring us eventually to the capital asset pricing model. So we'll start with portfolio optimization. You can read this part here in the investment and risk management textbook by Albrecht and Maurer. But again, you don't need those textbooks. You can simply have a look at these slides. Okay, now we've seen different investors can reach different points on the efficient frontier. Remember what the efficient frontier was. If we have n securities, the efficient frontier looked something like this. And one could ask oneself, is there a difference between a point, let me just use a different color here, maybe a point here or a point here. At this point, based on what we've learned so far, we cannot distinguish between these 2 points, and both are optimal in the sense that if your individual risk preference tells you to prefer, let's call this point A, with respect to, in contrast to point 2, 1 and 2, not A and B, 1 and 2, then that's your choice. You have individual preferences, you have an individual risk aversion or risk attitude. And if you think point 1 is more preferable, then you should invest in portfolio 1. If you are more risk friendly, if you're more risk loving, then maybe you are willing to accept a higher risk for a higher return, and then you will move to portfolio 2. So there's no difference in the sense that all investors will invest in portfolio 1 or everyone will invest in portfolio 2. It depends pretty much on your subjective, on your individual preferences. So as a result, we have a preference function, which is now called V of R. And this is a function in the mean return and in the volatility, and it depends on those 2 parameters. And this is decision relevant for you as an investor. For example, we could have the following preference function, which is V of R equals the expected return minus A times the volatility, with A being larger than 0. And A now obviously is a risk aversion parameter, because if you have higher risk aversion, then this volatility of your investment, of your portfolio, will be higher, and thus risk aversion and risk in general will be given a higher weight in your preference function. So what do you need to do then? The individual optimal investment program should obviously not be based on maximizing return. It could be maximizing return under the constraint that you keep risk at a certain level, could be okay, but then would be very general. But for an individual investor, you need to look at the preference function, or sometimes, of course, this is also a utility function, because you get utility from your best risk-return combination. So actually, the individual optimal investment program is based on your preference function. So you're maximizing V of mu and sigma. Your decision variables are those portfolio weights x1 through xn. And this is maximized under the condition that obviously the mu sigma combination you're looking for should be not only, it should be feasible, so it should be included in M, so in the set of allowed combinations. It should also be efficient, of course. So this is actually a maximization under certain constraints. So if we look at two securities and this preference function with the risk aversion parameter A, we get, for example, mu2 plus mu1 minus mu2 times x. And we know the variance of our portfolio with two securities. This is simply, let me write this down. This is simply sigma for the portfolio, and actually sigma squared. And then again, we want to maximize this. Take the first derivative, set the first derivative to 0, and then if you solve this with regard to x, this gives you 2a divided by sigma 1 squared plus sigma 2 squared minus 2 sigma 1 to the covariance. So for actually a going to infinity, we get the minimum variance portfolio. Meaning what? If you have infinite risk aversion, you get the minimum variance portfolio. Because then, if you're absolutely risk averse, you want the minimum variance portfolio. That's clear. Now, for an optimal portfolio, obviously, it must imply that the mu sigma combination, the portfolio we have, is not just only feasible, but it must also be an element of the efficient frontier. So it should be on this eggshell here, or here, or here, and not, for example, here, because in this case, this portfolio would be dominated by this one here. Okay, so it should be efficient. In many cases, however, the above stated problem of optimization is modified in practice in the following way. Instead of a direct optimization of the preference function, you're not looking at the preference function with respect to risk aversion, but you are building your own your own preference function in the way that you're comparing your portfolio's return in excess of what an index or a benchmark is paying you. So, for example, you take the DAX, the S&P 500, the MSCI World Index, and you're saying, I'm trying to optimize my portfolio return in excess of the S&P 500's return. So the task is now to choose the portfolio weights xn in such a way that the portfolio achieves the highest possible return in excess of what the S&P 500, for example, would have returned. And usually you take a stock index, DAX 30, S&P 500, and so on. Okay. Now, that's the optimization relative to a benchmark. If we optimize a given portfolio relative to a benchmark, we are led to the following problem of optimization. Maximize the expected return of your portfolio minus the expected return of your benchmark, with the portfolio variance being the same as the variance of the benchmark. So you want to have the same risk as the benchmark, but you want to outsmart the benchmark. So this is actually beating the market, trying to beat the market index or the benchmark index, and the weights should, of course, add up to 1. Okay. Now, when it comes to the optimization of portfolio, we are often interested in controlling and checking the portfolio's overall risk. And we could do this by saying, for example, the portfolio variance should be, actually it should be 100, should be the risk of the benchmark, or should be maybe lower than 100 if this is a good threshold. But what is often done actually in practice is a so-called safety first approach. In a safety first approach, you first start with a shortfall probability, and you can call it SW. The shortfall probability of R is the probability that the return is smaller, lower, or equal to a certain threshold Q alpha. That's obviously a quantile later on, and it will not surprise you that you can choose, usually it will be the value at risk or the expected shortfall, but this is the general definition of a shortfall probability. So in this definition, Q of alpha obviously represents an alpha quantile of the return distribution. If we now demand that the shortfall probability lies under a certain threshold epsilon, this will be equivalent to Q alpha smaller or equal than Q epsilon. And the introduction of such a shortfall constraint leads us to the determination of quantiles of the return distribution. And you might remember this either from quantitative risk management or the financial risk management class in the bachelor's program. And you use an empirical distribution, you can use a parametric one, you can also use Monte Carlo simulation to come up with an estimate for your shortfall constraint, for your value at risk, for your expected shortfall. And here we simply assume that we have normally distributed returns, so the alpha quantile of the standard normal distribution, the Z quantile, is absolutely sufficient to calculate this shortfall constraint. So actually what we get is that Q of alpha should be smaller or equal than X alpha, which in this case is determined by the Z quantile. So if we assume that this is actually normally distributed, we get that mu has to be higher than Q alpha plus the 1 minus alpha Z quantile times the volatility, the standard deviation. And what now happens is that actually we get our eggshell. Let's say it starts here and it moves like this. And what is interesting now? Remember that if we do optimization under constraints, what will happen is, actually I need a line, sorry. What will happen is that we will choose some point, for example here. Is this point feasible? Yes. If we now include a shortfall restriction, this means, for example, we could also start here. And if we have now higher risk, it can actually look like this. And what happens now is that actually we have to keep in mind this is a linear constraint, but this also means that the only area that is feasible, sorry, switching the colors here, the areas that is, let me just see if I can get this transparent. Not really. Let's use light color. The area that is actually feasible is this. Because we are demanding in our constraint that only portfolios for which the return is higher than our shortfall constraint, only these points are feasible. So this means, well, you get the idea, that only points in this turquoise area, only points in portfolios in this area are feasible and satisfy this constraint. So actually we have to look at this area here. And this means that these points on the efficient frontier, these points violate our shortfall restriction, our shortfall constraint, this one here. So these points, they are not allowed. Okay, now the blue line has vanished, sorry for that. And this point here, this one is okay. And you can see by increasing volatility, we move to this constraint, and then this constraint, and then last but not least to this one, which I plotted. Okay, that's how you can include this shortfall constraint here. If we now have a certain, if we now fix volatility here, but if we now demand a higher return, then we get these three constraints. And if, for example, the efficient frontier were to start here, then we would again see that only those points that lie above this shortfall constraint, only those here, they are allowed and they fulfill the constraint. Okay. So next, let's deal with the case of several periods. We demand that the probability of the weighted return, of the average return, being larger than m, this probability should be higher or equal to 1 minus epsilon. For example, we could ask that the probability of an average return of at least 5% over those days from 1 until capital T is higher, the average return, the probability of the return being higher than, let's say, 5%, this probability should be higher than 95%. Now, again, we assume that we have normally distributed returns, so we have mu plus z quantile times sigma divided by the square root of t, and for equivalently, this is for a quantile, and if we now put it on the right side and solve for mu, we see that mu has to be larger or equal than m plus z quantile times sigma divided by square root of t. And on this next slides, you can see how this restriction now and this constraint on the probability of the average return being higher than m%, how it will have an impact. You can see, again, it changes the volatility. Even though the volatility stays the same, you can see that the number of days has an influence. So if we increase the number of days, actually you have to go down, if we increase the number of days, it is easier for us to fulfill this constraint. Why? Because we have now more days on which the return will fluctuate, and this will, on average, drive this constraint down. Okay. Furthermore, we could require the return to be higher than a certain minimum in every period. So the return on day 1 has to be higher than 5%. The return on day 2 has to be higher than 3%, and so on. And this probability should be higher or equal than 1 minus epsilon. Now let's assume these are all IID. Let's assume we have a constant minimum return. So the MT is constantly M. And we see if all those returns, if they are IID, independent and identically distributed, this is stochastic independence. And we know for stochastically independent variables, you get the joint probability as the product, and then we get simply the probability of R being larger than M taken to the power of T. And for the constraint on the probability, we then have probability of R larger than M is larger or equal than the T square root of 1 minus epsilon. And as this term is a quantity that increases with t, this is a tightening of the constraint on the minimum required return. And in the next step, we want to include the presented shortfall restrictions in the optimization of portfolios. So first, we take our safety first approach to the optimization of portfolios by integrating those discussed constraints into the optimization scheme. We get the following program: maximize the expected return with respect to the probability of the return being smaller or equal than m. This probability should not be higher than epsilon. The weights have to be between 1 and 0, so we have no lending, we spend all our money, and we have no short sales allowed, and all those x's should add up to 1, so we're spending all our budget. If we now assume a certain statistical distribution for the returns, like we've done before, for example, a normal distribution for the returns, the first constraint can be transferred into a quasi-deterministic linear inequation so that the optimization is relatively easy. Such a shortfall constraint separates now the space of possibilities M into 2 disjoint sections. And we can, of course, also include additional constraints for specific days or asset classes and so on, and that's not a problem. But what will happen is you have your eggshell, you have your efficient frontier, and so on, And you now have different shortfall constraints. Let's do it in red. Maybe like this, for whatever reasons. And you have to take the intersection of all these. I hope this is okay. Okay. And this is the space in which you have to optimize now over this function. This function here, and so on. For these three red lines indicating three constraints. If you take the black ones, obviously you get a slightly different set of feasibilities and space of possibilities. Okay. Now, how do you do this in practice? Actually, for portfolio selection, you have your input data, you have your market data, you have your expected returns, you have volatilities. You need the covariances and the correlations. Your investment and portfolio management will tell you what the preference function is, what the benchmark is, what you are trying to achieve, and the output obviously is a set of optimal portfolio weights. You need to include transaction costs, you need to include your constraints and risk control and backtesting and so on, and this will then be included in your optimizer. What are some practical problems of Markowitz portfolio optimization? Now, optimized portfolios often have extreme allocations, for example, with very high short selling weights, meaning that you have 1 million in cash and you're spending 50 million in one stock and you're short selling the other stock for 49 million. And you have extreme allocations when it comes to certain assets or asset classes. So under most circumstances, this is not realistic, it's not desirable, because again, you will be exposed to single assets, even if this, mathematically speaking, if this is the optimal portfolio. Moreover, the portfolio weights are very sensitive to changes of the model parameters. So if you have your set of expected returns of your mu's and sigmas, it might be that even the slightest change to one of your model parameters means that you now have to shift your portfolio, and you suddenly have to change your portfolio weights, meaning you have to move a lot of cash, incurring transaction costs, which so far have not been included in this model. So optimal solutions commonly weight assets with high estimated returns stronger, and in practice you need to include transaction costs and efficiency and liquidity issues. Otherwise you will be stuck in a situation where you have extreme portfolio weights, and these will change a lot and you will lose all your money in transaction costs. Okay. Next, now let's look at the capital asset pricing model, the CAPM. Use of these mentioned problems of Markowitz optimization in industry practice, it is usually only used for asset allocation. That is the allocation of your investment budget to asset classes and not individual securities. At the security level, however, we are using factor models. And the best known example for such a factor model is the capital asset pricing model of Sharp and Lindner and Trainer. And another well-known example is the Farmer-French or Farmer-French Carhart model. Those are two variants. I'll come back to those later, but the capital asset pricing model is the prime example of a factor model. So let's let Ri and Rmi be the returns of the ith individual security or of a market index. That's why it's Mi. We look at the following market model or factor model. We argue that the individual return of a stock is given by an alpha I, plus beta I, times the return on the market index plus a stochastic error. Epsilon I is pricing error, and it's stochastic. So in the CAPM, the market index portfolio is given by the market portfolio in itself, and it is not approximated or proxied for by an index. So we're not saying this is the DAX, we are saying it's the universe of all securities that are traded in the market. It's the market portfolio. And for this simple one-factor model, we have the following assumptions. The expectation on those pricing errors is 0. The variance is given by sigma I squared, and the returns and the pricing errors, they are uncorrelated, and the covariance is 0. So under these assumptions, it follows that the covariance is given by BI times the variance of the market return, the market index, or BI is given by covariance divided by the variance of the market index. What does this tell us? First of all, we call BI the beta factor of the investment I relative to the chosen market index portfolio. And at the same time, we can see that the expected return on a stock I is given by AI, the so-called alpha factor, plus the beta factor times the expected return on the market index, or in other words, the alpha factor is the expected return on the individual security minus the expected return on the market index. In other words, this is the excess return. This is the excess return on the individual security over the market portfolio. In addition, we can see that sigma RMI equals the sum of those index weights times the correlation times the volatility of the individual security, and thus the volatilities of the individual investments enter the volatility of the market index just partially. Again, we can see that obviously the individual volatilities do not constitute the portfolio or market index volatility as a whole, but we still need the correlations and the covariances. So if we break down the individual volatilities, we get two components. The first one is given by this, the correlation of the individual security with the market index and the volatility of RI, plus 1 minus the correlation times sigma RI. And this first term is called systematic risk, and the second term is called the unsystematic risk. Meaning what? The systematic risk stems from the fact that each security systematically moves in lockstep or vice versa with the market index. So if the market moves, the individual security will also move according to its sensitivity to the index portfolio, to the market portfolio. In other words, its systematic risk and the correlation and the beta factor with the market. The unsystematic risk is unnecessary risk, if you will, and in a portfolio you can try to reduce unsystematic risk to 0. You can diversify this away. And in these equations we can see that only the systematic risk contributes to the volatility of the market index, and the unsystematic risk can be eliminated or diversified, and the beta factor can thus also be given by not just rho times sigma divided by sigma of the market index, but this is actually the systematic risk of investment I divided by the market risk. And then based on these results, we can now derive the CAPM, and we no longer have to assume a linear structure for the relation between RI and RMI, but we are making it more general. So the parameters, the AIs and BIs, the alpha and beta factors, they can actually be estimated using empirical data. And what we are doing here is classical OLS, ordinary least squares. We have our points, we have our dots, and we simply take a linear line and we fit a linear function to this cloud of points. So as input data, we take the observed returns of the market index portfolio, and in practice one sees that this assumption, especially of a linear structure, is often not fulfilled, but in the sense here, in this first idea, we can do this. This is the empirical estimation of the beta factor. We have the market return and the individual return. We have all our individual stocks, and then we have to estimate the regression, and we get the alpha factor and the beta factor here based on this. Okay. Now we replenish our model, which has already included n risky securities. So we have n stocks, and we now also include a risk-free security R0. Could be a government bond. And note that the assumption of one risk-free interest rate is a strong model theoretic simplification. Usually you have many risk-free interest rate, risk-free securities. You have a term structure of interest rates. Those risk-free rates are depending on the maturity, but we make the very strong assumption that we only have one risk-free rate for all maturities. So any amounts can be invested or borrowed at the risk-free interest rate. All investors take the indexes in expected value and variance into account. A is between 0 and infinity. It's the part of the available amount of money which is invested in a portfolio, and the remainder is the part which we are investing in the risk-free investment in the government bond, and thus we have the return is A times our portfolio plus 1 minus A times the return that is risk-free. So we have, let's say, 1 million euros. We can put 200,000 euros into our risk-free bond and 800,000 euros in our risky portfolio in the market. So for the whole portfolio based on the risky portfolio and the risk-free investment, we get the following. Mu, the portfolio expected return, is simply given by this one, R0 plus A times the excess return over the risk-free rate. And sigma squared is simply A squared times the variance of the portfolio. Why? Because the variance of the risk-free investment is obviously 0. So we get A equals sigma divided by sigma p. So, and this implies mu, the expected return on our portfolio consisting of the risk-free investment and the portfolio is the risk-free rate plus, and this is interesting, what is this? It is the so-called Sharpe ratio. Mu of the portfolio minus R0 divided by the risk of the portfolio. So this is the Sharpe ratio of the portfolio of our securities. And this Sharpe ratio can be used for risk-adjusted performance measurement. Why? In this previously presented form, the Sharpe ratio compares an investment I with the risk-free bond. And instead of R0, you could also use a benchmark. In this case, we get the generalized Sharpe ratio, or what we call the information ratio. So instead of R0 here, and this being 0, we get the information ratio. Okay. Then, what are the feasible combinations with the risk-free investment? Well, obviously, we'll start here at R0. We wouldn't invest here because our risk-free investment, for no risk, we get a higher return in our government bond. We have our portfolio here. And for this portfolio, we would then, this is one possible security portfolio. And you would see that, well, you can choose any point on this line here, and any point on this line is a combination of the risk-free rate and this particular portfolio. Okay. Now, if we have two different portfolios, we can have this line here 1, we can have this line 2, and this line 3. So what you can see now is, remember that we have, let's say, let's do this here, maybe on the next slide. Yeah, we have different portfolios here. For example, this point, this point, this point, this point, this point, and this point. Now we will always start at the risk-free rate. And what happens now is, a risk-free investment with no portfolio would actually look like this. We always get the risk-free rate. We might have actually higher risk, but we don't want that. So it is better for us to move this line maybe to this point. We know that this portfolio is not efficient, so we are moving to this line. We know that this is also not efficient, so we're moving up. But actually, if we compare, let's say, this line here, let's put it above the black line, you can always see that in comparison to, for example, this and this line here, there are some combinations on the second red line that is actually more efficient. For example, you can move up and you see that this red line here is not efficient because you can actually find a point on this line here that is even better. So what happens is, you get the idea, you start at R0 and you move the line up as long as possible. And when it starts to go down again, for example, at this point, it will go down again. This is no longer efficient. So what you're getting is the tangent line. You get the tangent line and the portfolio, which is the tangent point here, der Tangentialpunkt, T. This is the optimal portfolio. And this is the Turbine separation, the famous two-funds theorem. The Turbine separation tells you what? If you're given n securities, let me just delete all this so you can see it more clearly. If you have n securities, risky, and one risk-free investment, what happens is the efficient frontier becomes a line, actually the tangent line, and you will now choose any point on this tangent line. If you take this point here, or if you take this point, or this point, you can see that actually you're always buying the same portfolio here of risky securities. You're simply investing more or less in the risk-free investment. And thus, this is the Turbine separation. It tells you that as soon as you introduce risk-free investment, everyone buys the tangent or the tangential portfolio, the tangent portfolio. Everyone still has a different risk aversion, different preferences, but he or she will now then say, okay, I have to invest more or less in the risk-free investment and the portfolio, but everyone is buying the same portfolio. And the Turbine separation is actually the foundation of passive portfolio management. Why passive portfolio management? Because you can now see we don't have to choose between this portfolio or this one, but everyone is interested in the same portfolio. And you can now hire a portfolio manager that offers this portfolio, and you only have to choose how much money you want to put into this portfolio, which could be actually an exchange traded fund, could be an ETF. Yeah? So that's the Turbine separation. And now, after having seen the Turbine separation, now let's look at the capital asset pricing model. Now the aim of the model is the derivation of equilibrium prices for securities. You want to have a pricing model that tells you, okay, this security should cost, let's say, 120 euros. So what are the assumptions? The market includes n risky securities, one risk-free security. Again, we have our previous assumptions. There are m investors with a budget VI, each in the market. The whole market volume is given by V equal to the sum over all investors. All investors have identical expectations and know the risk-free rate, the expected returns, the variance and the covariances. And at the start of the model, the market is in equilibrium, so demand equals supply. Every investor now buys an efficient portfolio PI consisting of the tangent portfolio with share lambda I and the risk-free security. The demand portfolio is given by sum over all VIs times lambda I's times XT. And on the other hand, we have a supply portfolio. The market portfolio M is defined that every individual security is fixed towards the relative share PI divided by P of the complete market, and the matching investment vector is simply given by P1 divided by P up to Pn divided by P. That's the complete market value, the price of the market, if you want to say, call it this way. And we have the individual prices. Now, supply portfolio is strictly determined, follows that in equilibrium we have to equal this. Pxm equals xt times the sum over the weighted values of our individual portfolios. So the consequence of this is, if xt and xm have a mandatory shape as investment vectors, that xt and xm must be equal, and that the price has to equal, the market price has to equal the sum of all those values. So in equilibrium, t equals m. This means the tangent portfolio is identical to the market portfolio. So actually this here, this tangent portfolio is the market portfolio. That's the first result of the capital asset pricing model. That actually, yes, you start with the tangent portfolio. You have no clue what this tangent portfolio looks like. It turns out it's the market. It's all the securities in the market. Okay. Now we derive some further central consequences. First of all, the set of all optimal portfolios is now given if we know the tangent portfolio. The expected return equals the risk-free rate plus the Sharpe ratio times the volatility of the individual return, so sigma I. And this results in a straight line in the mu sigma coordinate system, and this is called the capital market line. Next, the market portfolio has maximal Sharpe ratio. And only portfolios that duplicate the market portfolios in the risky part are optimal for an investor. So in practice, this is passive portfolio management or indexing. You're trying to build to mimic the market, den Index nachbauen. And this is passive portfolio management because you know you cannot beat the market. Okay. Next, for the expected return of any portfolio, we have that this is given by R0, the return of the risk-free rate, plus the beta factor times the excess return of the market, and this is called the security market line. And you see this on this plot. This is the capital market line. You have sigma and the expected return here, and we get the capital market line. And the security market line is with the beta factor on the x-axis, so this is the difference. Capital market line, security market line, and obviously here we have the mu and sigma of the market portfolio at this point, and we have the beta factor of 1 and the expected market return here in the security market line. Okay. The beta factor measures the sensitivity of the individual return towards changes in the market return. And if we rearrange this definition, we get the following relation. Excess return on the portfolio or the individual value corresponds to the excess return of the market weighted by the beta factor. And again, with the excess return divided by the risk of the market portfolio, being this as the market price of risk, this equation of the security market line can be interpreted as follows. Expected return equals risk-free interest payment or risk-free return plus the market price of risk times systematic risk. So that's one result here. And finally, if we now combine all this together, you can actually also get a pricing model, meaning what? That on the left-hand side here, you have the price of the portfolio and thus the price of the securities. And the price is equal to the expected value divided by 1 plus R0 plus the weighted excess return on the market portfolio. So the price of the portfolio corresponds to the expected return discounted at the risk-free rate corrected with the risk premium in a nutshell. So that's the pricing model and the pricing function in the capital asset pricing model. Okay, so far any questions? Okay, then let's talk a little bit about convex optimization. First of all, we want to look at this in very general terms. We want to look at the optimization problem. We have to minimize a function f of x under the conditions that x is in some solution space S in the n-dimensional real space. Now, first of all, please note that we only need to look at minimum problems and minimization problems. Why? Because first of all, this is actually not a conclusion, very weird, this is a simple fact. Any maximization problem can be converted into a minimization problem simply if we see that the maximum of f equals and actually this maximization problem is equivalent to minus the minimum of minimization of minus f of x. So those two are equivalent. Then the solution of such an optimization problem includes searching for a global optimum x star in the solution space S such that f of x star is smaller than f of x for any x in the solution space. It could be that such a global optimum does not exist or is not unique. Moreover, the problem is possibly unbounded, then could be infinity, minus infinity, and the solution set can also be empty, so then there is no solution. And regularly, there will also be a local optima. In this case, the resulting x star is only optimal in a small vicinity, in a small neighborhood around x star. Okay, so what's the local optimum? So let's start. G is defined in MATLAB as at x. This is the function handler. We call this function polyval, and we call it G, and the function body is polyval 1 minus 10.5, 39, and so on. So what we are doing is we are simply evaluating a polynomial, and x vet is a vector of x values from 1 through 4 in steps of 0.05. And let us now then plot this, and we see, well, we have one local minimum here and one global minimum here. And obviously, some algorithms will run into this one, some algorithms will run into the global minimum. Now let's first use the function fmin_unc, which is function minimization unconstrained, no constraints, keine Nebenbedingung. And let's illustrate this in MATLAB. So x fval fmin_unc, let's use the function g, and let's start at 0. We get a warning, and as a solution we get x 1.4883, and the function value is minus 1.87. 1.48, well, this is obviously this point here, and we get our global minimum. If we now start at 5, and this function fmin_unc is pretty strong, it's powerful, you can see, well, if we start at 5, it runs into this local minimum, and we get no information that this is a local minimum. So we have to be careful even with very sophisticated functions in MATLAB. Now, a function can also have several global optima, and then the optimization algorithm will usually not be able to distinguish between the two. So let's have a different example. Let's use this polynomial, and you see we get one global minimum here and one minimum here, and they are both equal. We cannot distinguish between the two. They're both globally minimal. Okay, and in addition to the n-dimensional real solution vectors we assumed up to now, an optimization problem can also be infinite dimensional. We will not be looking at this. We are concentrating on finite dimensional problems, but I wanted to point out that there are also cases in which those vectors are infinitely dimensional. Okay. Then we can distinguish between optimization with and without constraints. An optimization problem is a constrained optimization problem if we have constraints, and the constraints can be in equation form, inequations, can be unrestricted, can be in the form of less or equal, and so on, can be linear, non-linear, and depending on the types of constraints and what we are looking at, we can distinguish certain types of optimization. Next, if the target function f is convex and the permitted solution set is convex too, we call this a convex problem. If f is convex but the solution set is concave, We call it a concave problem. What is convex concave? If the function looks like this, it's convex. If it looks like this, then it's concave. So in convex optimization, we have a very simple result. In a convex problem, a local optimum is always a global optimum. That's why convex optimization is very handy. It's very practical because we don't need to care about whether this is a local or a global optimum. We simply know if it's an optimum, it's globally optimal. In a concave problem, the global optimum lies at the edge of the solution set. What does this mean? It means that, for example, if we are optimizing in this space here, and we have such a constraint here, then actually the result, and if this is the function, then obviously the solution will be somewhere on the edge of the solution. And let's say, okay, this is actually the function. Then it will be somewhere here, for example, or here. Will be on the edge of the solution set. Okay. Some other results. We start with convex functions without constraints. It's very simple. We get a simple result. If the target function f is convex, if it's differentiable, f will have a global minimum in the vector x star if and only if we have nabla f of x star equals 0. And this is actually what? Any idea? This is the vector that includes all the partial derivatives of x star. This is the gradient, which includes all those partial derivatives of f with respect to x1, x2, x3, x4, and so on. And that is, if we set all these partial derivatives equal to 0, then we can solve for x star. And this is actually the same as you've probably known from school from a long time. Take the first derivative, set it to 0. This is simply the multivariate analogon. That is, we need the gradient to be 0, and not just the first derivative, but the partial derivatives need to be set to 0. And then you get x star, and it's a global optimum. Now, a finite dimensional problem of optimization will be called linear if the target function as well as all constraints are affine linear functions. Why it's not called linear, but why should it be called affine linear? Well, in linear algebra, you've probably seen in your math class that a linear function is a function for which it holds that f of a v, with a being a scalar and v being a vector, is a times f of v, and it respects the addition, the sum of two vectors. However, a function f of x equals a to plus bx is strictly not linear, but it's affine linear. It's a linear function plus a scalar. So all those functions here in our optimization, if it should be called linear, the target function and all constraints should be linear, more precisely affine linear. We call this also a linear program or an LP problem, ein lineares Optimierungsproblem, ein lineares Programm. And you might have seen this in the math class in the first and second semester. For linear programs, we have the so-called simplex algorithm, and you solve it in matrix form, and you get the solution with the simplex algorithm. I'm not showing this here. If the solution set is restricted by x being required to be a whole number, this will result in a discrete problem in contrast to a continuous problem. Wir haben dann kein stetiges Problem mehr, sondern ein diskretes Optimierungsproblem. And if the target function is stochastic, we get stochastic optimization. So you see discrete optimization, convex optimization, stochastic optimization, linear optimization, and so on. Okay, a lot of input to process. I would say that we can stop here for today because we're well underway in the semester, and stop here. because next we'll be talking about all those different types of unconstrained and constrained optimization algorithms. We'll start with gradient-based methods. Gradient-based methods is actually, we can start with saying, well, if the first derivative of x, f of with respect to x, needs to be 0, solve for x, and this is a gradient-based method or a derivative-based method. You simply set the first derivative to 0, solve for x. You've done this in school. Now we are taking it to multi-dimensions. We are doing it in a multivariate case, which in this case means that we need the gradient. So these are gradient-based methods. When we'll talk about Newton method, we'll look at derivative-free methods, which are basically heuristic. And then we'll do this in MATLAB, and then we'll introduce constraints. And then, last but not least, we'll do this in practice. We'll take those algorithms and do portfolio optimization in MATLAB using real data. So if you have any questions, please stay in the Zoom room. And thank you very much for your attention. And otherwise, if you have no questions, see you next week. Thank you.